Welcome once again to the Ahern video podcast. I'm continually getting calls about how do I sell my business. I've done numerous podcasts. I've done numerous newsletters on selling and preparing your company for business. But 2015 is going to be a very active year. So let me go through the process one more time. If you've got any questions, yes, you can email me and I'll try and respond. But first of all, you have to be emotionally prepared to let go. And if you're not emotionally prepared to let go, don't even go any further. That's Ahern's rule number one. Rule number two, you have to be competitively priced. If someone tells you you're going to get 10 times EBITDA, or I'll give you a better example. A $10 million carrier tells me he wants $8 million for his business. He owns $6 million on his equipment. It's not going to happen. He said, well, his business broker told him that these kind of multiples are available. Well, he got bad advice. So you need to be properly priced. And get involved with people that have done numerous transactions and understand the industry that are truckers. There's a place for investment bankers, there's a place for business brokers, and then there's a place for someone such as Ahern that are transportation analysts. You need to find out which process you feel most comfortable with. Investment bankers are normally for larger companies. They're going to charge you a $25,000 to $50,000 retainer. They're going to then put a packet of information together. They're going to try and go out to at least 100 suspects and narrow it down to 5 or 6. They're going to negotiate with those people, and then at some point in time you'll get to interact with them. If that's the process you like, because all you're concerned about is money, then that's the process you pursue. Business brokers act on your behalf and they act as a go-between. They get involved in the contract negotiations, etc. If that's what you like, then you should use that process. In my process, or in Ahern's process, we believe that a buyer knows what they want, a seller knows what they want, so bring the parties together. If you've provided a range of values, then you need to be prepared to what to release, when to release it, and how to release it, and that's what we do. So assuming that you're prepared to emotionally let go, assuming that you're favorably priced and your expectations are not higher than the industry average, you then have to have a lot of information prepared before you ever go to market, because what will initially happen is you'll have an initial telephone conversation. If the conversation goes well, you'll normally sign what's called a non-disclosure that protects both parties. From the non-disclosure, you're then going to be required to start providing some information, and that's the key. And normally they're going to want to look at 3 to 5 years historical financial information. Even if for smaller companies you don't have audited financial statements, but hopefully you've got accounting footnotes. They're going to want equipment lists, and make sure you have values that you know are accurate. You don't have to go and spend a lot of money on an appraisal. That's just useless money. The buyer and the seller are going to negotiate on the value of the price, but are they going to pay retail? No. Use the term fair market value, which is about 10 to 15% lower than retail, but historically what's going to happen is they look at the wholesale market, they determine what they can buy equipment for, and that's what they're going to pay. That's normally orderly liquidation value, so look at that. And then you've got a variable, and that's the variable that you work with. Are they normally going to buy your terminal? No. Normally they're going to lease it with an option to purchase. Are they going to do a stock sale? I'd say today 90% of the time deals that are structured are asset sales, not stock sales. It has nothing to do with the perceived additional liability. It has everything to do with recasting depreciated assets at fair market value. But most importantly, once you understand what your number is, it's not what you get, it's what you keep. So before you even go to market, get a tax consultant, not an accountant, but a tax consultant, because in many cases people aren't properly prepared. For example, we were working on a transaction. I went through accelerated depreciation with the buyer, with the seller. He said he had none. We get ready to close on the transaction, and he finds out he owes $1.2 million of additional liability. That tells me two things. He and his accountant were not on the same page. The accounting firm that represents him really didn't prepare him properly for what was going to happen, because if he had that tax liability, then they should have worked on reducing that tax liability before they ever went to market. So understand what the tax consequences are. There's no way you're going to avoid the tax man. It's just a fact of life. If you're using accelerated depreciation, be careful about the recapture, but there's ways to get around that. In goodwill, you can put it in the form of a non-compete agreement, and therefore it taxes you differently, but you have to check with your accountant on that. But the bottom line is, get someone that understands transportation to work on your behalf, get a good accountant that understands transportation, and get a good attorney. Our job is to move processes along. Our job is, in many cases, we'll refer you to 2 or 3 transportation attorneys that have expertise. You choose who you want. But when you're dealing with all your advisors, it's very important you tell them what you want. You do not let them take control of the situation. You do not let them negotiate for you. Why? Because ultimately, at the end of the day, deals happen because you have the same moral and ethical values. You as a seller know what you want. The buyer knows what they want. You keep acting together. If you're a profitable company that historically has been profitable, do not expect to walk out the door tomorrow, because it's not going to happen. If you want to leave within a 1 or 2 year period, you better have strong management, secondary managements that can continue to perpetuate the company. Strategic buyers look for intellectual capital people. They don't look for just drivers and iron. So if I can impart anything to you, be prepared. Make sure that you're emotionally prepared. Make sure that you're financially prepared. Make sure that you gather all the information necessary before you go to market. Assemble yourself with a group of advisors that really understand, but their job is to advise and not get into the thrust of things. With attorneys and accountants, you got to seal them off. You got to say, okay, how much work do you think you do? Give me a final number, stick with it. If they're not willing to do that, then you're going to get sticker shock if the deal ever closes. A lot of times you should have a third party come out and review the company to make sure there's no red flags that are going to scare people away. CSA scores are very important, and the list goes on and on. So until next time, if you're thinking of selling your company in 2015, be prepared. The second rule is be prepared. The third rule is be prepared. And the fourth rule is be prepared. Until next time, thank you for attending the podcast.